All right, everyone, welcome to another Success Academy recap. This is Trader Travis, Success Academy co-trainer Peter. Everything we're sharing tonight, which we're going to talk about the general market. We talk about what we do and real traders or ordinary people, what we do with our real money in the stock market. It's for educational informational purposes. We're not giving investment advice. I don't think you want to take investment advice from me anyway, because I'm a guy who screwed up my money so many times, which is why I teach people what not to do. It's more or less like I think Charlie Munger, Warren Buffett's partner, said, one of the ways to get rich quick is not so much what you do. If you can just avoid some of the stupid stuff, it's easy to become rich. So I teach people to avoid the stupid stuff I've done on my path to creating financial independence for my family and I. So what we're going to do is we're going to start off. I'm going to give the floor to Peter first. The market right now, as we're talking about, is in it's in a correction right now. It's actually falling in price. And so you'll see what are we doing, during the correction, what our thought processes are, and how do we handle things like this. And so without further ado, Peter, take it over.
Thanks, Travis. All right, welcome everyone. So I just wanted to cover real quick. I was kind of talking to one of our Success Academy members the other day. We were talking about, she kind of said, how do you know when to get back in, this, that, and the other thing? There's a couple of things, if you look at my screen, that you can see. I've got something circled there. So we use an indicator called the 4 stages of a market crash, when it's not 100%, but it gives us a good indication of where the market is going and where it's anticipated to go, right? So a lot of traders use market indicators or moving averages as indicators. So for us, we were flirting with what we call stage 3. And then when you get into stage 4, that's typically when you've clearly seen the market has turned over and we're in a full-on bear market. So what we do is when we have 4 stages: stage 1, stage 2, stage 3, stage 4. Stage 3 got really close, but we didn't get back into it. But what I was telling one of the Success Academy members the other day was, you can see the market has come back, right? So you see it right here, it's come back and then it's dropping again. I wasn't real I can't think of the word, but I wasn't too confident that this was definitely coming back to go back to higher levels again. And the reason I wasn't is, Travis and I were talking about it. This blue line you see here is a 200-day moving average. So that's basically taking prices for the last 200 days. If we look at this correction back in February, we were flirting with that same stage 3 again over in this area. But the difference was the 200-day moving average was still pointing up. Today, when we were flirting with it, the 200-day moving average is now kind of crested. We talked about this last week. So do I know where the stock market's going to go? Nope. I'm just listening to it. And what it's telling me right now is, looking at the moving averages, it may want to go low again. So I'm just cautionary. However, one of the things I did do is I took advantage of this downturn. So we were kind of joking about this, Travis and I, and I guess the best way to put it, and no one ever really takes this advice, but I listen to the really wealthy people, and the really wealthy people do the exact opposite of what 98% of the population is doing. And why is that? Well, because they're 2% of the population that makes the most money. So they're doing different things, right? So if the wealthy people are getting on the elevator, that's what I'm doing, while everyone else is taking the stairs. So in this case, we talk about cash as a position, cash as a position. Travis talks about this all the time. So I was in a very good position to take advantage of this downturn here. So I invested in companies I want to own, and I invested in SPY. I haven't been assigned yet, but basically that's what I did. I sold cash secure puts on the stocks I wanted to own. They're on their way down. They're going to be super cheap if I get assigned. I'll actually be a little disappointed if I don't, but I won't be totally disappointed, because that just means my cash is in a position again to take advantage of the next downturn. So that's what I did. The other thing I did, when it started to recover a little bit, I took advantage of that with some vertical credit spreads. We use Market Club. So I used Market Club and I got into some spreads here. I don't think you'll be able to see them all, but I did Starbucks. Starbucks actually took off in price, so I was able to sell that spread and buy it right back like 3 days later, and I kept 89% of my credit. You can see that was a total of $331, so that was nice. I did some other ones here. I sold some more verticals, or I'm sorry, I sold some more cash secured puts on AT&T at $27 because I wanted to take advantage of AT&T was dropping. I don't know if it'll get assigned, but that's okay. And then I did some verticals that have a lot of days in them. And then over in this account, again, I did some verticals on Walmart and McDonald's, and they're looking pretty good. Walmart has a ways to go. Those were longer term trades because I needed to take advantage of open interest. So that's my trades. The other thing I'm doing, and I kind of wanted to show this, I'm reading. So I suck at reading. One of the things I listen to, I just started doing Tim Ferriss's 5 Bullet Fridays, and I listened to a podcast he had with the CEO of Walmart. And if you haven't listened to it, it's a fantastic podcast. But one of the things I noticed on all the podcasts is all these wealthy people, they're not only reading, but they're implementing what they read. So I'm reading the 4-Hour Work Week again. I read The Slight Edge, and I'll probably read that again. It's a fantastic book. But the 4-Hour Work Week has a lot of implementation action steps. So I'm rereading it, writing down the action steps, and I'm going to implement it. And then the other thing I'm doing, I went out and I got this book, Trading on Corporate Earnings. I don't know where you guys can get it. I got it at a local bookstore in Charleston for $5. It's a used bookstore. So I'm reading that because I wanted to start doing little fun trades on corporate earnings. So that's what I'm doing. Those are the things that I'm working on. Those are my goals for the upcoming month. I want to have this book done. Most people would probably read this in a week and a half, but I suck at reading. So between that and the 4-Hour Work Week, that's what I'm going to be working on. And then I do have some trades here and there. I'm still working on trade plans for the next few weeks, but not a ton of trading. I'm going to take advantage of hopefully another market pullback, or if it doesn't pull back, then I'll take advantage of a market going up. And if it doesn't do either of those things, I'll take advantage of a market going sideways. Because those are all the things that the guy to my right taught me, Travis. With that, I'm done.
Thanks, buddy. So, excuse me, I stepped out for a sec. Did you cover the general market?
I did real quick. Yeah, I just kind of covered what we talked about. I didn't. I pretty much covered it.
Okay.
If you want to cover it again, go ahead. But I just talked about what you and I talked about.
Okay. All right. So I'm just writing down real quick. Excuse me. The symbols. Starbucks, I heard you cover right when I jumped back on. So covering the symbols of stocks that I'm in that actually wound up making money. Did you talk about cash's position? I'm sorry. I keep asking.
I did.
Yep. Okay, good.
Yep.
All right.
That's where I talked about the market where I'm in a great position with cash. So I didn't tell people that's what they should look at doing, but hopefully they'll get the gist of what I was saying there.
No, that's a good thing. And actually, that's a good point because it leads to my point in how, and I won't share my screen, how the first market crash, excuse me, I need to stop saying crash, correction, happened. And actually, I will share my screen. Screen number 2 happened in January of 2018. I was not prepared, even though I anticipated it coming because I was sending out emails like, hey, I'm hearing people brag about how much money they're making and things like that. And so I was like, be cautious. But we trade what we see, not what we think we're going to see. So I had a lot of risk out in the market, maybe 20% of my account when I usually have 10%. So the first correction in January, I made a bunch of money, gave most of it back. This correction I was in better position for, and I only had maybe 2 positions out. So the majority of my money was sitting in cash. And so just like Peter, I was able to take advantage of it because the first correction, I couldn't take advantage of anything. I was already bleeding money. I'm like, I don't want to put too much risk out there. I just have to wait for things to sort out, and then eventually started making money as the year went on. This next correction, though, I was ready for it. As soon as my position started hitting X's, I closed them out immediately. And then I wound up having a lot of cash, and I was able to take advantage of like Starbucks and like Peter selling new stock insurance, or also called cash secured puts on stocks I want to own, because I was taking advantage of the lower prices. Other stocks that I wind up, and I put this in the Success Academy in my Excel. I gave you guys full, I showed you all the stocks I was looking at. I think I might have put J&J on there. That's one that's going up. Merck is another one. That's one I was in. Starbucks I was in. Verizon I got in. So I actually made money during this weird correction. Actually, I'm happy, but it's frustrating at the same time, because I traded all year. The bulk of my money I made the last 2 weeks, literally a couple of thousand more just on these symbols I'm showing you. So I hit my profit goal for the year. My account has 6% growth, all because of the correction. So this time the correction actually helped me out, because I had cash. I was able to get in these stocks at decent prices, and they wound up doing okay. And Walmart, I don't know if I covered Walmart. Walmart was another one I was in. And so I just made about 2 or 3 grand, literally working all year. I was about break even before the correction. Within a week, 2 times I hit all my money. I'm like, great. It almost, I could have took the year off and it just traded these 2 weeks.
Now you can.
Exactly. But that's not the reality. The reality is, like Peter talked about these leaders, the reality is you have to show up every single day. Mark Cuban is a billionaire, right? Mark probably couldn't have been able to predict which company he was be able to sell for billions, and people say, oh, he's lucky. Whatever. You show up every day, you'll find that, oh, I'm getting luckier and luckier, because you never can pinpoint what's going to be that one stock that takes you over the top. All you do is have to show up, though. So you're in that position to take advantage of it, because the people who aren't showing up, who are scared of the crash, and sadly, Peter, I didn't tell you this, I'm part of other programs, other training programs. I'm a student first, coach second. And it's heartbreaking. I'm on their live calls. These are trading programs. And, his students are like, different programs. I wrote it down. Gosh, where is it at? I don't think it's on the sheet. I was writing down how much their accounts were down. The market had a 10% correction, right? Some of the students in that program, their account was like, oh, I lost 20%. I lost 30%. I lost 45%. One guy was like, my account, I lost 50% of my money. 50% of your money? The market only went down 10%, right? And I'm like, he's taking on too much risk. I'm like, there's no way in the world, nobody in the Success Academy should lose 50% of their account, because we don't teach that kind of aggressive risk management. If you do, let me know, so we can don't suffer in silence. If you're suffering, don't worry about it. Yeah, I'm blunt sometimes, but still, we want to help you out. So it was heartbreaking. It's like, what do you think would happen to that account? And I'm going off on a tangent here, but what do you think would happen to that account if the market actually crashed? He lost 50% of his account in a small little correction. If the market crashed, he'd be bankrupt, right? So goes back to my insurance concept, right? You got to insure your account. And one of the ways we insure our account is we don't put ourselves in a position to lose 50% of our account. That's one of it's called self-insurance, right? We don't put a lot of our money out in the market in the first place, right? Second is, if you do happen to have a lot of your money in the market, buy and hold, is buy protective put options, right? So I'm pulling up a sheet here. Can you see this, Peter?
Yeah. Yep.
So as Peter was talking earlier, I pulled up one of the insurance contracts in my account. This is insuring one of my accounts. And I highlighted here in red how much money it made today, $489. So as the market's going down, this is going up. So when you have corrections like this, use them as feedback. Don't get all upset and pissy about it. Just use them as feedback. That's the only way you can kind of find holes in your investment strategy. So look at what you own, mutual fund stocks, it doesn't matter. Is anything going up today as we're recording this on November 12th? I don't know the day. I don't even know the day. 12th. November 12th, right? Look at your portfolio. Did anything go up today? And that's what I was doing. I'm looking, what went up today? Some of the stocks I just profiled went up today. This went up, my protective put. I'm like, okay. So I'm starting to see, okay, if the market does crash, I'm in a decent position because I have something that's going to offset that. That goes to what I was going to talk about, bonds, right? There's this different allocations, 50% stocks, 50% bonds. Another allocation is maybe 70% stocks, 30% bonds. Traditionally, the reason people do that, let me pull it up right. Historically, the reason people would have bonds in their account is diversification. Bonds historically have done the opposite of what stocks do. So when stocks crash, let's pull up a 20-year chart of TLT. This is a long-term bond fund. And we pull up the market crash, these two green lines right here. I already have it drawn. I must have covered it another time. So anyway, let me edit that out. Okay, so in between these two green lines here, this is the market crash of 2007, 2009. Bonds went up when stocks went down. And that's generally how bonds would behave, right? Well, people would allocate 30% of their money towards bonds with no problem because they're like, well, it's supposed to help me when the market crashes. But why do people have a problem allocating 5% of their money towards a protective put? See, bonds are effective, but they're woefully inadequate, in my opinion, because there's no guarantee they're going to go up. And they're definitely, if you look at it now, if we pull up a 9-year chart, the stock market has been going down the last month. What is this long-term bond fund has done? It's gone down too. So people are thinking bonds are going to be their savior. No, bonds are not correlated to stocks. They're correlated to interest rates. We're in this weird interest rate environment. So people think bonds are going to behave normally, and they probably won't during the next crash. So why are people having they're okay allocating 30% of their money towards bonds, but not 5% towards puts? And as I just showed you here, puts are both effective and adequate because the way they're structured, they're guaranteed to go up in price when the stock market falls. So puts replace bonds, and that's why it can be 100% stocks. People are like, why you never talk about bonds? Because I don't need them, right? The puts offset in the volatility. The puts protect me when the market crashes. I don't need bonds, right? And then the options I use for income, so I don't need bonds for income, right? So anyway, I just wanted to talk about that because people are still struggling with the concept of buying insurance for their portfolio. They're like, it costs too much. Well, if you have money in bonds, well, I'm not giving investment advice, but I'll tell you what I did. My money that would have been allocated to bonds is allocated towards insurance for my account, protective put options. That's the money, that's the accounts that are fully invested. Like I have 100% of my money out in the market. Now, short-term options account we've been talking about, I'm always heavy in cash, so I'm never worried. That's the kind of built-in insurance that strategy has. So I'm looking here. We talk about cash's position. Peter went over the market, talked about bonds, and Peter also talked about, it's not just about making money. I was explaining to him today, I was reading a book, hanging out with my son, because I'm like, as a trader, I rarely get a vacation, right? The market's always open. But times like this, where it's not really ideal to really be in the market a lot, I'm taking advantage of it. It's a high divorce rate in this country, right? Everybody can better their marriage. There are kids who hate their parents because their parents aren't spending enough time with them. So use this as an opportunity to better yourself in other areas, because that should be our goals. It's not really to make money. Our goals should be better versions of ourselves. That includes money, but there's other areas too: a better parent, a better father, a better husband, things like that. So when the market has these weird corrections like this, where you can't really find trades, or you're scared to place trades, you're losing money, well, then take that energy and focus it in other areas, and that will balance out the negativity you feel with the market. You'll feel better about yourself. I'm sure Peter feels better about himself that he's reading a book now versus just kind of staring at the market every single day and neglecting other areas of his life. So that's my philosophical rant today. I don't think I have anything else to share. Did we cover it all, Peter?
Yeah. There was something I was supposed to say and I didn't say, and I can't remember what it was, but I can't remember what it was. I think we did. I mean, the bottom line is I wanted to just let everyone know. Oh, I didn't tell everyone. So I placed trades, my verticals that I placed. I usually show you guys what my cash flow was. So all those trades I placed, it was about $1,300 or $1,400. Now, I was a little upset because it should have been more like $5,000 to $6,000, but I got to fix my new trading account because it wouldn't let me place all my trades. So, and that's just something I have to do with my broker. But the point I said to Travis, I said, I'm not really that upset because we always talk about, everyone thinks, oh, I missed an opportunity. Yep, you did. But it doesn't mean another one won't come. Mm-hmm. Another one's going to come. Who knows? It might be right around the corner, because look at the market today. It could be right around the corner. So, and if you can't capitalize on it this year, like Travis says, then let 2019 be the year that you take advantage of getting your cash in order to capitalize on it next time. Mm-hmm. So, but that was it. Yeah, I think, between the two of us, I think we covered what we wanted to cover.
All right. Well, that's it. We will see you into next week's recap. You all take care. Be safe. Be encouraged. There's still ways to profit and make money in the stock market, no matter what it's doing, up or down. All right. You all take care. Talk to you soon. Bye.
See ya.